please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Halftime Report. It's 12 noon and what's dominating the financial headlines is the fact that the rupee continues with its free fall, plunging to 72.5 against the dollar, taking its monthly loss to about 5%, its year-to-date loss to close to about 13%, making it one of Asia's worst performers. Also keep your eye on the bond prices. They have fallen to a fresh 4-year low. Bond yields are now at 8.135%, and this is after the current account deficit also widened to 2.4% of GDP. Nigel, let me add that equity markets too are falling. So now as we speak, the Nifty and the Sensex are down close to about 1%.
Well, we're at the low point of the day, Rima. And if you take a look at the data from the end of January, you'll see that the Sensex is up nearly around 5.5%. But in dollar terms, it's down actually 7%. And that's the impact really that the FIs will be feeling. Remember, at the end of July, we saw FI flows pick up. But, now it'll be quite interesting. We'll have to monitor those flows because they were saying we're putting in money at around 69.5 odd. At worst, we'll go to around 72.5. We're already at around 72.5 and we're falling very, very rapidly. So FI flows as well will have to be monitored because at this range, maybe in fact, the worst is yet to come in terms of the rupee. Low point of the day, even some of these, these IT and pharma stocks that should be gaining, they as well are selling off. Infosys should come up for you on the screen. That's taken a leg down. Even Sun Pharma is moving low as we speak. And even IndusInd Bank is taking a bit of a knock in the last few minutes. We're down 115 points, so the intraday chart of the Nifty should come up for you. But let's get straight to the top story that we're tracking. The Indian rupee hits a fresh all-time low of around 72.5 odd to the US dollar, with the benchmark bond yield trading at its highest levels we've seen in the last 4 years. Lata joins up with all these details. Well, Lata, it was not supposed to be very, very worrying, but the pace at which we are falling, that's definitely worrying, isn't it?
Well, now it is definitely getting to a spot of bother, and I'll tell you why. The less worrying part is that this is part of an EM contagion, emerging markets contagion. Two things have gotten worse over the weekend. On Friday, we got excellent jobs data, which meant that any chance of fewer Fed rate hikes definitely goes out of the window. Maybe they are more. There was also that very scary tweet from President Trump saying that, there's a further 267 billion of tariffs that he's contemplating, and Japan is also on his radar for trade talks and tariff reductions. Now, this is what has rattled the EM currencies, and both are negative. Usually when the US jobs data is very good, it's the mother economy, and therefore other Asian economies expect that they will do well because the US economy is doing well. But now that positive from a strong US dollar is getting taken away because it looks like the US will grow and grow alone, and maybe at the expense of the productivity gains of emerging markets. So it's coming as a double whammy. In the 2003 period, we saw the same thing. Strong US growth, but it did not lead to a fall in Asian currencies because Asian currencies were expected to benefit from trading with the US. Now it's coming as a double whammy. US growth plus trade tariffs and slower growth for EMs. So today, everything, Indonesian rupiah, Korean won, that's a huge fall. That's about 0.6. That's the second worst currency. The worst trophy, of course, goes to rupee. Now, this could also be because the rupee had the largest number of long positions. It was seen as the strongest market and the strongest currency in the region, and therefore had a lot of long positions. It's also a large liquid market compared to rupiah and the Filipino peso. So, it is like when you are in trouble over, say, any of the smaller stocks, then you will go and sell your Hindustan Unilever to get money. Or you will sell perhaps an Infosys or a TCS. If you need liquidity, then you go to the market which is liquid and where gains can still be made. And that is perhaps rupee's problem as well. But what I see as a problem is what you said, that, now the fall has come despite the government talking up. S.C. Garg's interview was clearly intended to tell the world that I think the rupee has fallen enough, and now the government of India believes that we worry about the rupee's fall. the Friday intervention by the Reserve Bank seemed to walk that talk. And there was fairly strong, maybe $2 billion of selling. That's the number doing the rounds in currency circles. But despite all that, today there is, it's almost like the bottom has fallen, and now there is genuinely a fear factor. Until now, I was chiding y'all and telling you not to say free fall, but now, you just are forced to use that word because it has become a rather rapid fall. And I think it's our experts have joined us, so let's straight away get to them. Divya Devesh of Stand Chart and Bhaskar Panda of HDFC Bank are with us. Devesh, let me come to you first. The rupees, although we keep saying that the fundamentals are better compared to several other countries, it's come in for more punishment lately and particularly today.
Actually argue that fundamentals are not that solid. Okay. And I mean, what we are seeing is sort of different from what the rupee weakness that we had in 2013 or even 2015, in the sense that this move, to my mind, is not really being driven by speculative money. It's actually just a mark-to-market of the new reality in terms of the trade deficit and the current account deficit. As we all know, trade deficit has widened from single-digit to now almost $17–18 billion a month. And I think there was a certain INR depreciation necessary because trade deficits at $18 billion a month is simply not sustainable. So I think that's exactly what we have seen. We have seen about 8% weakness in real terms, real effective exchange rate terms, which was actually quite necessary just to ensure that the trade deficit does not keep on increasing.
No, I take your point. In fact, the Indian government, including the finance minister, had not been very alarmed when the rupee fell below 70 at some point in time. That was thought as psychologically important. But they took it calmly because, the July trade deficit was a bit of an alarm, a red flag for the economy itself. But, we have moved a distance from 69 to 72. So the expectation was that around 72, there should be some kind of a support. Now, at what level do you see equilibrium coming at all? Can there be an overshoot?
Well, there definitely can be an overshoot. As we all know with FX markets, it rarely just goes to the fair value and stops there, right? It always either undershoots or overshoots. And I think the approach from the government so far has been not to really be too aggressive in terms of verbal intervention. We did see some comments, as you highlighted earlier, from the Economic Affairs Secretary, but they were not too aggressive. I think markets are really waiting for the government to take a more aggressive stance or either sort of announce that they are looking at certain measures which could stop the move. But so far, I think there have been no new announcements or not even comments or rhetoric coming in that they are looking at new measures to stop the rupee depreciation. I think, just one final point on that. I think the government's and I think the RBI's approach has been exactly right in the way that they have managed the currency depreciation this year. Because if they had tried to be too aggressive in trying to stick to certain levels, say 68, 86, which was the previous all-time high, or 70, the psychological level, markets would have continuously tested them on those levels. And as we have seen in a number of other emerging markets as well, these kind of thresholds never really hold. Markets always test those, and those levels always get broken. So I think, yes, the RBI has probably been supplying dollars intermittently, but they have not really stuck to a particular level yet, which I think is again, the right approach in managing this kind of weakness.
We did a dipstick survey some time back, and the mood among the bankers was that 72 would be the average, but about 20% thought it would go up to 74 in the overshoot, and another 20% thought it would go to 73. Let me get Bhaskar Panda in. Bhaskar, you were one of those who thought that 72 and even at 71.50 the rupee had fallen enough. What is the sense you are getting now, falling despite intervention?
I think, as my predecessor said, it's an overshoot which is happening, and it's very difficult to predict where it will stop. So if I look at the technical charts, probably it might go towards, now 74.58 or 74.60, which is where there will be resistance. But having said that, I personally feel that it has been very overextended. Unless and until there is something happening in the overseas market, which I don't understand, we should be extending this loss towards the figure that I quoted. But I don't agree with my predecessor that we are not doing well. India is doing well in terms of positive growth and all those things.
No, he was referring to the current account deficit only.
Current account deficit was bad. Obviously, the number was definitely bad. That we all knew, right? With the kind of oil prices and the kind of trade deficit, the growth in exports. So all those things is known to us.
Okay.
But should we be punished for this? My answer could be no.
Okay. But is it largely importers selling, Bhaskar? What exactly, or is it those hedge fund positions that are being unwound? What looks like the nature of the dollar buying?
See, importers are buying. Obviously, even if they ask me what to do, I tell them to at least, cover at least for the next 1 or 2 months, because uncertainty is there and nobody can put a figure where dollar rupee is going to trade in, say, next 1 or 2 months. So they are there, but those are regular imports. Maybe some demand is coming from people who who had not hedged earlier and now hedging. Rest of things come from overseas. Most of the moves start overseas overnight, and then it spills over to us.
Devesh, what is your sense about the EM sell-off itself? Does it have much more legs? I mean, each day a new tweet and a new strong data point from the US.
Actually, Leza, I think the points that you mentioned earlier on were exactly right. We are sort of in a unique situation where the dollar is actually being benefited by both ends of the dollar smile. You have U.S. economic outperformance, which means more Fed rate hikes, higher U.S. rates. That is supportive of the dollar. But at the same time, we also have increased uncertainty or risk aversion in markets coming from the U.S.-China trade tension sides. So we are really in this unique situation where dollar continues to be supported by both ends of the dollar smile. And I think that suggests that unless there's a catalyst to change this narrative of a stronger dollar, things are not going to change. And that catalyst, I mean, there are 2 or 3 things which can happen, which can change the story. One is either U.S. and China come to a trade deal. Another one potentially could be U.S. midterm elections in November if the Democrats do well there. So I think unless we get some of these catalysts, it's difficult to predict a turnaround for emerging markets yet.
Okay, 72.61 against the dollar, so the plunge continues. There is no stopping the rupee on the way down. Devesh, so the rupee has adjusted itself to the new realities. What about the bond markets? The bond prices are at a fresh 4-year low. The yields are now at 8.13, 8.14%. Your thoughts on the yield and the trajectory going forward?
Well, I think it's very much a function of what's happening in the FX markets as well as rupee weakens. Naturally, markets think that it's going to be inflationary, possibly more RBI rate hikes will be necessary, and that leads to further weakness in bonds, and then again that triggers more INR weakness as well. So I think unless we see some sort of stability in the exchange rate, that it is difficult to predict that bond yields have topped. Clearly, I think, if you just focus on the bond fundamentals, those, in my view, are still relatively solid. But given what's happening on the external side, it's very difficult to say that we have reached a peak in terms of bond yields yet.
Okay. What's your sense, Bhaskar?
I think I completely agree with what Devesh said. Because it's a function of what is happening in the forex market rather than the fundamentals right now. Probably we'll also see if oil remains higher and dollar rupee remains higher. I mean, it is anybody's guess where bond yields could go.
Okay, no, I mean, it can't be that bad. What is it, 8.15, 8.2?
I think it can go towards probably 8.2 and then stop. I really don't know. I mean, it's very uncertain times that I have seen in my long career.
So even in the currency, you think now 73 looks like a credible threat?
Yeah, as I said, it can go overshoot 73, go towards 74.
Yeah.
So.
Oh, yes, I take your point. Devesh, I mean, what is eerie is now the rupee is falling more than other currencies. And that's why I'm coming back to it. You know, it is still an 8% growth that we have behind us in the first quarter. And even for now, for the full year, the growth forecasts are still at 7.4, 7.5. That still should mean that at some level of the rupee, stock markets would become attractive and bond yields would become attractive and people would come back. Do you see that happening at some point in time?
I think you're right. Again, it's if you just purely focus on valuations, those are definitely attractive. But that is true for a number of emerging markets, right? India 10-year yields at 8.1, 8.2% is really attractive given where inflation is right now. But it's really a question of sentiment rather than valuation here, because even though people realize that, yes, valuations are attractive, this is a trade that people have been stopped out of a number of times this year, because valuations are attractive today, but it can be even more attractive in a week's time, in a month's time. So it sort of really comes back to two things for Rupee as to at what point do investors say, okay, this is attractive enough for me to enter. Either on the broader story, you see a catalyst, which makes things positive for emerging markets, or on the domestic side, you see authorities taking a much more aggressive stance and trying to limit INR weakness, which again, as I said, is not really clear yet.
Okay. Well, we have to wait for that hour, and that's what the market's waiting for. Bhaskar Panda and Divya Devesh, thank you very much indeed for joining us. Well, I don't have to add anything more. 74, both of them think can be crossed, because when you're in a mood to overshoot, things just feed on themselves. Like you have a virtuous cycle. When things are strengthening, and because they're strengthening, you think the earnings would grow. Now, because things are weakening, you would worry about companies with ECB debt, you would worry about companies with large import raw material. And then, you would worry about higher inflation and therefore higher interest rate pressures on consumption. You saw the attack on FMCG companies. So everybody would wait that, okay, let FMCG companies get cheaper and the rupee get cheaper. I will buy it when it is cheaper. So it is at the moment a waiting game.
And we take your point that despite the government talk, it's not helped. The statements coming in from Subhash Chandra Garg was that I have maintained that 68 to 70 perhaps is the right level. I don't expect it to go beyond 72 to $1 perhaps is an outer limit or beyond the reasonable outer limit for depreciation. And those operators who are trying to take advantage of this contagion feeling in emerging markets may come to grief. So these are, some strong statements coming in from the government officials, and that too clearly has not helped the rupee. But 11,500 is gone on the Nifty. Now we're approaching the 11,450 mark. And even Infosys, which should benefit from the rupee depreciation, only hedges about 30% of its cash flows. So the rest of it, will directly benefit it. But even that stock is now at the low point of the day. And now we've even broken past Friday's intraday low level of 11,484 on the Nifty. And so many stocks, SBI, Indiabulls Housing Finance, Tata Motors, are all slipping hard as we speak.
And take a look at Axis Bank. It's supposed to be good news. The stock was up close to 4% in early morning trade. That as well has come out from the high point of the day. The Nifty Bank, that's down 300 points as we speak. So clearly there's some broad-based selling, that we are looking at. The flows at the end of today will be very, very important things. Really, it's a cocktail of bad news. The rupee at around 72.6 odd. You have the Nifty at the low point of the day. The Nifty Bank as well as selling off. And Brent crude prices continue to hold above $77